Tan Hui Beng, International Tax Leader with Deloitte Malaysia and Southeast Asia, joins me live in the studios now to further discuss the big picture of global minimum tax for Malaysia. Hui Beng, thank you so much for making time for us. How are you today?
Good, and thanks for having me.
Wonderful. Hui Beng, let's get started off with you perhaps sharing with us what is the current status of Malaysia's roadmap for GMT, considering that the time frame is short and Malaysia will also need to amend its domestic tax legislation to implement OECD's very ambitious targets for the rollout.
Thanks, Tamina. So the original plan by OECD was to really get it done in 2023, but it was obviously overly ambitious. So many countries have moved on to do it in 2024. For example, European Union, Korea, Japan, and many more countries. So for Malaysia, the question is really not whether Malaysia will do it. Malaysia will have to do it. The real question is when, right?
That's right.
2024 versus 2025. I think the latest will be 2025. The real question here is, will it happen in 2024? Last year, 6 October 2022, I think under the previous government, the Minister of Finance then did announce that Malaysia will introduce global minimum tax and the qualified domestic minimum top-up tax, the QDMTT, in 2024. But of course, since then, there's a change of government, and of course,
that's right.
On 24th February 2023 this year, the budget was retabled, and in some of the documents in the budget touchpoint, it was mentioned that QDMTT and GMT will be introduced. So based on the direction of travel right now, it appears that 2024 is possible, but we really have to wait for a firmer announcement by the government. But I feel that 2024 may be the start year for Malaysia, yeah?
All right, and it's also very interesting, Hui Beng, that you mentioned about the retabling of the budget, etc. But also last week, Deputy Finance Minister Ahmad Maslan did mention that GMT would likely be tabled in Dewan Rakyat by later this year. So would that happening, would that operationalize, and would that be a further emphasization of the fact that 2024 will be the year?
It seems to be, if it's going to be tabled before the budget, sometime October, and probably 2024 will be a start year. So maybe let me just emphasize on one point. When we say 2024, right, let's assume Malaysia does introduce in 2024, it means for any companies or group that having a year-end beginning on or after 1st January 2024, that will be the first, those will be affected by the 2024 year, right? So
their first fiscal year.
Yes, correct, absolutely.
Okay, brilliant. And another point that I would love for you to perhaps clarify for us, given your expertise, Hui Beng. Now, the country might gain about R1 billion in tax revenue for a start when GMT is introduced, yet Malaysia's current corporate tax rate of 24% is higher than the proposed GMT of 15%. Will standardization, in your viewpoint, actually lead to increased tax revenue?
Now, when the Malaysian government did mention about potentially collecting about 1 billion, right, ringgit Malaysia for under the GMT for the first year if we introduce, let's say in 2024, is a situation where multinationals having a foreign headquarters, let's say in UK, having a Malaysian subsidiaries in Penang, for example, right, Malaysian subsidiaries and enjoying certain tax holiday. Therefore, the effective tax rate will go down below 15%, right? And that's where the top-up tax under the qualified, the QDMTT will take place. And I think that 1 billion is from that. Now, Malaysia does not need to decrease the tax rate to 15% for sure. But the QDMT, the introduction of QDMT will ensure that Malaysia will be able to collect the top-up tax rather than allowing the government of the foreign parent to collect the top-up tax. So the QDMT is quite crucial, right? Yeah.
There you go. Wonderful. Thank you very much for clarifying that. Very important point. Now, moving along, Hui Beng, looking at two impacted categories of MNCs, which are the large Malaysian-based MNCs that have foreign operations and also foreign-based MNCs that have operations in Malaysia. How will the OECD GMT of 15% affect their operational costs, which may also be related to perhaps an anticipated outflow of them rather than continuing to stay on in Malaysia?
Yes. So as you have aptly mentioned, there are two types, outbound and inbound, right? Now, the fact is that what are the costs to them? Now, although the GMT has been set at 15%, it doesn't mean there will be necessarily be a top-up tax for multinationals group, because if you're operating in Malaysia at a normal tax rate 24%, that's unlikely to be going to be a top-up tax. If you're you're operating in Thailand at 20%, unlikely that's going to be a top-up tax unless you enjoy certain incentive, right? So top-up tax may or may not happen. That's one thing, right? Of course, it happens. It's an additional business cost. But equally important is, I just want to emphasize the one point, even though if you operate in a country where there's no top-up tax to 15% because your effective tax rate is already 15% or above that, there is a huge, massive compliance obligation. And that means you need more people, you need to automate your system, you need to have more resources spent on this thing. Now that is actually costly, right? So the cost comes from potential top-up tax as well as the cost in managing the compliance, right? Yeah.
Indeed. So I think that's very important about that when it comes to also the fact that the income inclusion rule, IRR being the main rule, is to be rolled out first, with the backup rule, the undertax payments rule, UTPR, targeted to be implemented the following year.
Yes.
Would you say that the investments required for the vast landscape that you just mentioned should already be in place in time for the IIR, or can it be done in a staggered manner?
Right. So when one's prepared for GMT, you got to look at it holistically, and when you prepare for GMT, you're going to prepare yourself for IRR, UTPR, and also the one thing that it needs to be emphasized is the QDMTT. Why I said that? Because in the rule order, if there is a top-up tax, the QDMTT is the one that is going to operate and pick up the tax. I'll give you a very important example.
Sure.
A US-based multinationals having a Malaysian subsidiaries, again, the same example, enjoying tax holiday, 20 years pioneer status. Therefore, Malaysian effective tax rate is going to be probably 0%. Now, there's going to be a top-up tax to 15%, right? The question is, who collects the 15%? Malaysian government will collect 15% if Malaysia introduces QDMTT, which Malaysia would. But assuming if Malaysia does not introduce QDMTT, that 15%, the money that is on the table will go to the government of the US, for example, right? So obviously, all governments in the world are likely to introduce QDMTT. So when you prepare when a group prepares for GMT, it's preparing for everything, for QDMTT, for IRR, UTPR, so on and so on. So it's all in one package, right? Yeah.
All right, brilliant. Really well put. Now, of course, GMT will only apply to MNCs operating in at least 2 jurisdictions. Yep. They also require an annual consolidated group revenue of at least 750 million euro, which amounts to about 3.5 billion. So definitely not something to sneeze at. And I think we can definitely anticipate that this will be rolled out by the associated bodies. So moving along to the qualified domestic minimum top-up tax, the QMDT, which is part and parcel of GMT. Yep. Do you feel that similar to how Hong Kong and Singapore, we would be rolling that out? And have you seen the frameworks emerging, at least for the relevant MNCs in Malaysia already?
Right. So you're right. Singapore have decided to do the QDMTT in 2025, although many other countries are doing in 2024, and likewise Hong Kong. And the reason Hong Kong is doing in 2025, basically they are just emulating Singapore because they are competitors in that sense.
That's right.
And the question is...
Financial hubs.
Absolutely. And therefore the question from Malaysia is, do we follow them, or do we go ahead to do in 2024? I think that is a question of policy, and the question that government have to ask, whether we give a bit more time to foreign direct investment to adjust itself to 2025, or we are risking, Malaysia is risking itself from losing a revenue if it doesn't do it in 2024. And I think the Deputy Finance Minister mentioned about 1 billion ringgit, the potential loss. So that's a balancing act here, right? Mm-hmm. But at the end of the day, it will come. It's a matter of time. Right?
That's right, exactly. So it all depends on what the powers that be, especially legislatively, decide what is best for the country moving forth.
Right.
Very important, considering this has been quite the bonanza year for FDIs. Yes. Moving the conversation along, Hui Beng, now how can the two categories of MNCs mentioned earlier start preparing for effective and also efficient implementation of either GMT or QSMMT?
Right. So assuming Malaysia does that in 2024, and let's assume that group have a December year end. So your first affected financial year will be 1st Jan 2024 to 31st December 2024, right? So what do they need to do right now? Indeed, they should be doing this yesterday, not today. It has to do in a robust way. they have to do an impact assessment to look at whether there's a top-up tax or not. If there's a top-up tax, what is the implication, financial burden? Is it going to impact dividend payout? Cash mobilization, for example. That's on impact assessment. And then in the countries that you're operating where you have tax holiday, whether you need to renegotiate the incentive, whether you need to see the investment agency. I think you can't just be sitting down and say, okay, it is what it is, right? You got to see if you are having a tax holiday, what do we need to do with the tax holiday? Because the tax holiday could be a little bit less relevant with GMT, right? So then moving on, we got to look at the compliance, we look at data readiness, make sure your data is good enough to produce the GMT computation, whether we need to have an automation, or we can do as business as usual manual calculation, which is impossible to do that. There is going to be
the volume of data.
Absolutely,
yeah,
right.
Absolutely.
So all this needs to be done. And one important word I have to highlight, especially for the CFO,
Sure.
this GMT thing, with the amendment to International Accounting Standard number 12 in terms of income tax, just for example, the Malaysian listed group, for example, that's having a December year end, their first major financial disclosure under IAS 12 is not actually in 2024, it's by end of this year, 31st December 2023, end of this year. There's one financial disclosure that you need to talk about your preparedness towards GMT, your potential impact. And you can imagine if you don't do the impact assessment, how would you be able to do the proper disclosure? Of course, there's one option for a company to say that they could have a statement to say that, well, we are still assessing it, but look, the stakeholder, the investor will not be happy with that kind of disclosure because
naturally, because this is hot news on the market, right?
That simple disclosure will only mean the CFO has not done his or her job, right? Obviously, you want to elect for that kind of disclosure, you want to have a more robust disclosure, and the stakeholder will be happy with it.
Yeah, absolutely fair, considering that, as you said, the clock is ticking faster than ever, especially
Absolutely.
for our listed companies. Right. Moving along from there now. So, of course, as you just mentioned, so one of the major considerations is configuring the accounting system for generating the volume of data required for GMT, followed by, of course, a trial run to ensure all systems are go. Can you break down what this looks like when operationalized, getting down to the nitty-gritty, Hui Bang?
Right. So, well, the law is there, but automation is not mandatory, obviously, but from practical aspect, probably one have to do that. The reason is simple, is because if you're operating in many countries, and in that particular countries, in the foreign countries, or even in Malaysia, we have many companies, right? So the data has to be consistent. There are a lot of data points, more than 100 data points where you need to look at to generate the data. Therefore, you really got to make sure you do a proper mapping, and the accounting system needs to be modified. So multinationals have two choices, right? Number one, the existing accounting system, they try to modify, to cater for GMT. Or the other option is to really look at what is available in the market, the GMT calculation engine you probably buy from the vendor, and then you try to integrate your existing accounting system to generate the data. But the way I look at it, for most Malaysian-based multinationals, probably you have to opt for the later, because to modify your accounting system is not easy, right? So all these will be essential and has to be done in no time. Yeah? In
no time. And cost efficiency wise as well, just for discussion's sake, is it the first option or the latter option?
I think
all factors considered.
Yeah, I think it depends on the merits of each case. But I think from practical aspect, the later option probably will be more sustainable, and you at least can rely on the vendor to update whatever needs to be done, right? But if you have a huge IT team, competent IT team, then of course modifying your own accounting system is also a big possibility, right?
Absolutely. Yeah. All right, so as we move towards summarizing, so what are the full impacts of GMT and how should affected MNCs move forward in your perspective?
Okay, so again, look at the two categories, very important. The inbound situation, if you're having a tax holiday, you probably need to see the Malaysian Investment Agency to see what could be done. If there's a top-up tax, you've got to live with that. But in that area, I'm very confident and I'm very sure the Malaysian government, together all the investment agencies, are really looking at the ecosystem, not looking only on tax incentive, because with GMT tax incentive may be less relevant, still good, but less relevant, less effective. So Malaysia's government will be really looking at other non-fiscal factors. supply of labor, rule of law, intellectual property protection, so on and so forth. The non-fiscal factor will become a very important factor to attract and maintain the FDI in Malaysia. That's for the inbound case. For the outbound case, the Malaysian listed co, they have to assess their situations overseas, whether they need to see the investment agency in Singapore, the EDB, or elsewhere, doing the same thing, right? But all in all, I want to say this. To those who think that GMT will not come in and they're praying hard that it will just vanish in the thin air, it will not happen. I think it's imminent. So GMT waits for no man. We have to brace ourselves for these new forms of taxation, which is the largest tax reform in the history, actually. So we got to brace for that.
Absolutely, once in a lifetime, as you said.
Yes, absolutely.
Thank you very much, Hui Beng. Excellent discussion and conversation, and that was, of course, super insightful. And appreciate making time on Niaga Spotlight. That's all we do have time for on the week for Niaga Spotlight with me, Tamina Kowski. We'll see you next Friday with more business analysis and insights. Here's to a productive week ahead.